Hello everyone. As we have discussed earlier in our earlier session on call option trading, the stock market, that is the secondary market, can always move obviously after the bullish way, that is you are expecting the price of the shares to increase, and it can either move the bearish way, that is the price of the shares are expected to be in red, that is they are expected to be down. And this uncertainty justifies the claim of the people, of say some people, that stock market is nothing but a sort of betting. So we will not agree with the financial aspect of this, because there is always tools like fundamental analysis and technical analysis, along with the overall market conditions of the overall economy of the country as well as the world, that we can easily anticipate, or not if exactly, but quite correctly estimate the direction, whether the market is to be on a positive side, that is bullish note, or a bearish note. So either you can trade in the equity as we have discussed, or instead of trading on the equity, you can trade on the derivatives. And we have discussed that primarily these derivatives will either be the futures or the options. And we have brought our focus to the option trading, where we have underlined that these options can either be European options or the American options. But whenever you see the Indian market, whenever there is a price of an option, it says E and the end. This E denotes that it is a European option. Because normally Indian trading market are only trading in European options, because they give a flexibility that though you may trade, but the actual settlement has to be only on the strike date. Whereas in the American option, the holder may have the authority to encash it or at any time before the expiry date, and that under increases the liability of the writers, option writers, hugely. And that is why, to be on a level playing field, we normally deal on a European option. And these options, as discussed earlier, can either be call options or put options. Therefore, you will always see either CE or PE at the end of any option quote. So we have focused on the call option trading in our last session on financial investment, where we underlined that some people can expect the market to be on a bullish note, and obviously others may not feel so. So when there is a contradiction between the two people, then the person who believes that the market will be on a bullish note, positive note, may buy the call option, and the other person who believes that that will not be the case will sell such call option. Therefore, we use the word that such call option buyer was known as the call option holder, whereas such call option seller was known as the call option writer. Now, with this reverse aspect, we can, instead of trading in call option, we can trade on a put option, where the person who is believing the market on a bearish note, that who believes that the market will be on a negative side, and therefore he was ready to sell such call option, may instead opt for the buying of a put option. So this put denote the right of such party to sell a particular derivative, or we should say that it provides an option or the right to such person to sell the derived equity, the underlying equity, at a particular price which has been fixed at the time of entering into the contract, that is known as the strike price. And therefore, the person who was here on a bullish note and was ready to buy the call option may sell such put option. So, in a way, the person who was having the bearish option may have the option to either sell the call option or buy the put option, and vice versa. The person who was on a bullish note can either buy the call option or sell the put option. But why these two options are there? Because when you are a writer, you have to pay the margin. Whereas if you are a holder, you only have to pay the option premium. And this option premium is much less as compared to the margin. So those with lower funds availability, they can instead becoming or getting into the position of writer, they always become a holder, and on their belief whether the market will be bullish or bearish. If they believe that if the market is bullish, then they can go for the call option, and if they believe that the market will be bearish, they may go for the buying of the put option. Instead of a person instead of becoming the writer, and becoming a writer will require him to pay huge margin money, resulting in requiring large liquidity, may instead become the holder, which requires him to just pay the premium, and this premium paid becomes his maximum loss. So instead of just liquidity, तो यहाँ पर लिक्विडिटी की रिक्वायरमेंट कम है, यहाँ लिक्विडिटी रिक्वायरमेंट ज़्यादा है, और यहाँ पर रिस्क भी ज़्यादा है, और प्रॉफिट लिमिटेड है, बिकॉज मैक्सिमम प्रॉफिट इज लिमिटेड टू द प्रीमियम रिसीव्ड एज वी हैव डिस्कस्ड अर्लियर. बट अगर आप अगर आप ऑप्शन के होल्डर बनते हैं तो लिक्विडिटी भी कम है, आपका रिस्क भी कम है, बिकॉज योर रिस्क इज लिमिटेड only to the maximum loss of premium paid, and there is unlimited profit possibility. So this unlimited profit possibility, low risk, low funding, always prompts a person to go and become the option holder. And if they believe that the market will be on bullish side, then they can always opt for call option, and if they believe that the market will be on the bearish side, then they can always go for the put option. So in this session, we will take up some examples on put option trading. So I believe with this much discussion, if there was any doubt regarding the option or the confusion that whether we should opt for the put option writing or call option holding, and vice versa, that is call option writing or the put option holding, then you will feel that you are in a similar position, but it's all about your liquidity, risk, and profit best possibilities. So, put option, what it implies that obviously there will be two parties. One will be the put option holder, as discussed earlier, and another will be the put option writer. And they have entered into a contract known as options contract. And whenever there is a contract, there are two parties which have been justified as holder and the writer, and then there has to be a mutual consideration. So this put option holder will pay a premium, that is the option premium, which is the liability by the holder to the writer. In return, will get the consideration, that is the right to sell the underlying equity, at a particular price. That is the strike price. That price will be known as the strike price. So what it is implying, that if a person believes hmm, कि मार्केट गिरेगी, तो अगर एक इक्विटी है जिस कंपनी का नाम लेट्स से एक्स लिमिटेड है और उसका जो करंट मार्केट प्राइस है, लेट्स से द प्राइस इज ₹50, and he's entering into a contract of 1 month expiry. So after 1 month, he expect the price to be 40. ये उसकी expectation है. And that person who is believing is, let's say, Mr. A. And there is Mr. B who believes otherwise, that the current price of P0, that is rupees 50, will be on a bearish note and the price is going to be at least 55. Now, this what they expect is in their personal mind, but believing that the price will go down and believing that the price will go up, they enter into a contract of strike price 45. And for this strike price of 45, the premium is say rupees 2, with the total quantity size known as the standard lot size of say 250 shares. Let's make it bigger, 2500 shares. So what is happening, that here Mr. A and Mr. B are ready to enter into a contract known as option, where after a period of 1 month, the strike price of 45, that is Mr. A wants an assurance from B that he will be selling the particular shares of X Limited, or he should be selling 2500 shares of X Limited at a minimum price of rupees 45. So B believes that I can assure you that I will charge rupees 2 at the premium per share. So A will give 2500 into 2 as rupees 5000, the premium to Mr. B. And B is of the opinion that the price will be much above than 45, because his expectation was it will go to 55, but here he was entering into an obligation to pay only rupees 45. So he believed that the price will be much higher than 45. So if the price is much higher than rupees 45, then A obviously will not enforce this option and he will get this rupees 5000 as his income. So he says, I provide you the right. You are given a right to sell at the rate 45. Now, what is happening here? That because A have got this right to sell, so he becomes, as discussed earlier, the put option holder. And because B has assured and received the premium, that is why he has become the put option writer. And this whole contract of enforcement will depend that what is the actual price after 1 month. So the strike price was entered to be 45, but what is the actual price? Now, if actual price is more than rupees 45 or equal to 45, more than or equal to 45, then obviously such put option won't be exercised. क्या लिखा, मोर देन और इक्वल टू? तो अगर मार्केट में रेट 45 हुआ तो 45 रुपए मार्केट में मिल रहे हैं, 45 रुपए उससे लेने हैं, तो वो लेगा क्यों? मार्केट से खरीद लेगा, कि खरीदना चाहेगा तो, बिकॉज ही वॉज ओनली wanting the option to buy, not he was ready to buy, sorry, ready to sell. So because the market rate is 45, तो मार्केट में बेच देगा, सॉरी, यहाँ क्यों बेचेगा इसको? क्योंकि उसके पास एक हक चाहिए था। अब अगर 46 है, 47 है, 48 है, कोई भी रेट हुआ, या एक और 55 है, तो इसके ऊपर का जो भी रेट होगा, then why will A exercise his right to sell and sell at a rate of 45 when he can sell higher at the market? So if the price is more than 45 or equal to 45, then the put option will not be exercised. So A has got a maximum loss of rupees 5,000 and B has got a profit of rupees 5,000. But if somehow, if somehow the actual price is less than 45, then in such case A will exercise his right to sell. And because he will exercise his right to sell, so it denotes what? That if the price is, let's say, 44 rupees, then the actual price in the market is 44, but he can sell it at 45. So instead of actually enforcing the contract to sell, he believes that he has got a profit of rupees 1, because the price difference is 1, and that becomes the profit of the put option holder. But he has already paid a premium of rupees 2, so still he has a net loss of rupees 1. Whereas, as far as the writer goes, he is ready to pay -1 as his loss, as corresponding to this profit, but he has already got rupees 2 as a premium. So there will be a net profit of +1 for the writer. तो बेसिकली 2500 यूनिट के हिसाब से 2500 रुपये यहाँ लॉस हो गया और 2500 रुपये यहाँ नेट प्रॉफिट हो गया। यानी कि राइटर ने पहले 2500 सॉरी 5000 रुपीज प्रीमियम रिसीव किया, 2500 रुपीज जो उसकी लाइबिलिटी थी वो पे कर दी, और उसे बाकी बैलेंस प्रॉफिट हो गया। लेकिन अगर ये जो एक्चुअल प्राइस है ये 43 हो जाएगा, तो अब जो लॉस है वो या डिफरेंस जो है वो 2 रुपए का हो गया। तो जो होल्डर है, होल्डर के लिए 2 रुपए प्रॉफिट हुआ, 2 रुपए प्रीमियम दिया, तो नो प्रॉफिट नो लॉस हो जाएगा। और राइटर के लिए 2 रुपए वो ले चुका है और 2 रुपए अब उसने पे कर दिए, उसका प्रॉफिट भी नील हो जाएगा। यानी कि इफ द एक्चुअल प्राइस इज इक्वल टू स्ट्राइक प्राइस माइनस द प्रीमियम, if actual price is equal to the strike price minus the premium, then in this case option, or we should say the put option, won't be exercised. Sorry, I should say that put option will result in no profit and no loss to either holder और राइटर। तो दोनों के दोनों नो प्रॉफिट नो लॉस पे निकल गए, दोनों पार्टियां ब्रेक इवन करके निकल गई। लेकिन अगर यहाँ एक्चुअल प्राइस 42 हो गया, तो होल्डर ने अब 3 रुपए कमाए, 2 रुपए प्रीमियम दिया, +1 प्रॉफिट हो गया। राइटर ने 3 रुपए खाए, 2 रुपए प्रॉफिट कमाया था और उसको -1 रुपीज लॉस हो गया। तो we can summarize that if actual price is equal to strike price minus premium, then there will be no profit, no loss to holder और राइटर। कौन से वाले? पुट ऑप्शन। अगर एक्चुअल प्राइस इज मोर देन स्ट्राइक प्राइस माइनस प्रीमियम, जैसे यहाँ पर क्या हो रहा है ऊपर वाले केस में, ये एक्चुअल प्राइस ज्यादा था, है ना, एक्चुअल प्राइस ज्यादा था और ये इन दोनों का डिफरेंस, यानी कि अगर एग्जांपल के तौर पर ये 46 था और ये 42 था, तो इस केस में जो पुट ऑप्शन है इट वोंट बी एक्सरसाइज्ड, क्योंकि उसकी जरूरत ही नहीं पड़ेगी, एंड होल्डर विल बी एट लॉस एंड राइटर विल बी एट प्रॉफिट डिपेंडिंग अपॉन कि कितना डिफरेंस है, जैसे कि हमने ऊपर नोटिस किया कि यहाँ राइटर को प्रॉफिट आ रहा है। और अगर एक्चुअल प्राइस इज लेस देन द स्ट्राइक प्राइस माइनस प्रीमियम, जैसे 45 में से 2 हुआ माइनस तो 44 आया और एक्चुअल प्राइस 43 था, जैसे हमने एग्जांपल लिया, तो नो प्रॉफिट नो लॉस तो बराबर हो गए थे। लेकिन अगर ये 45 था और ये 2 था तो ये डिफरेंस आ रहा है 43, और ये फिगर अगर 42 हुई तो आपने क्या नोटिस किया दैट दिस विल रिजल्ट, तो यहाँ पर भी पुट ऑप्शन यहाँ पर एक्सरसाइज हो जाएगा, विल बी एक्सरसाइज्ड एंड होल्डर विल बी एट प्रॉफिट एंड राइटर विल बी एट लॉस। बट यहाँ पर ऑप्शन होल्डर का जो लॉस है वो लिमिटेड है या अनलिमिटेड है, दिस लॉस कैन बी लिमिटेड लिमिटेड टू प्रीमियम पेड, और इसका प्रॉफिट भी लिमिटेड है टू प्रीमियम रिसीव। तो इस वाले केस में प्रॉफिट और लॉस दोनों के दोनों लिमिटेड हैं, एंड दैट इज द की। Is this case, I both the losses of the holder is limited. Similarly, the profit of the writer is also limited, and both are limited to the premium paid. But here, this loss can be unlimited, and this profit can be unlimited. That is why option writing, and in this case, the put option writing is risky and shall be undertaken by trading professionals, जिन लोगों को ट्रेडिंग करनी आती है, प्रोफेशनल्स हैं, by trading professionals only after due research and observations. So it is not like that anybody can enter and become a writer, because this option writing, कहते हैं ना, ये बच्चों का खेल नहीं है. You can always go and buy the option and be content that if this option goes wrong, then you will be knowing that this is the maximum loss that I have paid. So when you buy a option, whether it is a call, whether it is a put, you are paying the premium upfront. You are paying the premium upfront, and now you know that either you will lose whatever premium has been paid, or because it's a European option, and if the market is moving as the way you anticipated, then there will be a negotiability in the premium, and you can always sell to any other buyer at the amount which is more than your premium paid, and you can generate the profit before the strike date comes into existence. But so therefore, you yourself know what is the loss you are ready to incur. So it is always a limited movement on negative side to the new buyer. So that is why those people who are new to the market should either trade in the equity, and if they are entering into the arena of the derivative trading, then they must not enter firstly into the arena of the writing, and they should only stick to to the holders, that is option holders. So we will always advise that if you believe that the market is going on a upper side, that you expect the market to be on a bullish note, then you can go for call option holding, you call option buying. And if you believe the market to be on the downside, then you can always opt for the put option buying. And that is why you can satisfy your expectations, and that is, and with that too, add the limited loss that you have already paid in the form of the premium, believing that you will exit at the profits. So on this note, we close this session on put option trading.